Hi, Shubham. How are you?
Good, doing well, Andy. It's
I'm good.
been a very interesting times in the markets. We say that every week. So, how are you?
I'm doing well. It is interesting times. It's when we scheduled this interview, I thought of after the fact that we're having a Fed meeting today, so which always creates some volatility in the marketplace. But really, reached out to you, listened to you a few different times, and you had a lot of interesting things to say, I thought. And so just wanted to get your take, your current take on the markets, the energy markets, specifically the oil markets as they are right now. And then yeah, let me give me what you think.
Sure, yeah. That's really the multi-billion-dollar question. I guess we'll put it that way. So, I think there's been a lot of call it contradictory or opposing narratives that have gone created here as the year has gone on. Obviously, we are marking the 1 year anniversary of the June 7th or June 9th top that we had last year. I think many equity investors would like to go back 1 year.
That would
and
be me.
yeah. I think many of us included for sure would like to go back there. But I think one of the big things that's really that I would like to stress is that the supply demand thesis wasn't really wrong. The supply demand thesis has played out relatively exactly how we had predicted. Sure, did the Russian barrels not drop off as much as was predicted? Yeah. Did demand not pick up in certain parts of the world as much as was predicted? Maybe that's still yet to be seen. I think demand looks relatively quite strong. The supply has come on a little bit more than was expected, and here we are. So the supply demand thesis looks relatively strong. Still, what did change is the impact of the Fed. So the Fed raising rates a lot higher than was expected hasn't caused the slowdown that we had expected, but what it did cause was a complete financial capitulation in terms of the open interest in the markets, in terms of the number of people willing to speculate and buy long contracts on oil, on diesel, on natural gas, on sort of all across the economy, and also the physical market. So at a time when, let's say, the Fed was at 0% interest rates, maybe we could run excess 500 million barrels of crude across the world because people were willing to carry that cost. Now, people are no longer willing to carry that cost, so we need a much lower inventory in order to get to the prices that we were predicting that we would get to. So that's essentially where we are, and that's essentially why OPEC has now cut twice, one being the voluntary cut, one being the Saudi Arabian lollipop cut. They want to bring these inventories down. What they've realized is the market is not responding to an undersupply. The market is responding to the actual level of inventories in the market. And what better way to get the inventories down than to create a massive undersupply, bring those inventories down, and then you leave the world at your heels. OPEC then controls the market, and we just need to wait to get there. And in the meantime, guess what's happening? US rigs are dropping 40, 50, 60 rigs a month. So
Yeah,
there's a second order impact and a third order impact, which is that when prices are lower, demand goes higher. So you've softened the impact of higher interest rates with the fact that the price of oil is 30, 40, 50% lower than it was. So naturally, that impact of the recession is going to be already taken on by the fact that prices are much lower than they were a year ago.
Yeah, a lot about that. I want to work out a little bit more. I was trading a lot in 2007 and 2008, and I remember when everything just went just well. I can use. I'll be careful with my words, but just went down a lot. And I don't really. I mean, the more things stay the same, the more things change, the more things stay the same type of thing. But I don't really think it's that case anymore because you have an aggressive, correct me where I'm wrong in my logic, because I see you have an aggressive OPEC right now, and also inventory levels are not that high, are they? I mean, correct me where I'm wrong on that. I mean, we've had some build up, but it's not significant. Correct me if I'm wrong.
Yeah, no, you're absolutely correct, and this is one of the things that gives the supply demand fundamental thesis so much validity, is that it's not like inventories have gone through the roof, and all of a sudden the price of oil has gone down. The inventories are still relatively flat to drawing, and that's where we are. So what really has changed is how much excess can the world is the world willing to keep and then still have a high oil pricing, and seems to be in a 5% interest rate environment, we need even lower inventories. And you know what, my good friend was here last week in San Diego visiting me, and the comment that was made is they want to run oil, global oil, on a just-in-time sort of business fashion, and that is one thing that the world should not be running on a just-in-time fashion. But that's what the world seems to want here, and that's what we're going to get, because OPEC is hell-bent on getting there, as you alluded to.
Yeah, and do you think that move was a panic move, for lack of a better word, by OPEC? Because then again, I know that they're like Saudi's state budget, if you would, is they need $80 a barrel. But I still, again, looking at inventory levels, and it's almost like they didn't really have to, is what I'm an oil investor. I am long up to my eyeballs oil, but it was a little puzzling to me, and that's fine with me. I will benefit from that. But again, it goes back to the supply and demand and your thesis about just-in-time oil. It didn't seem like they did. So I guess I'm gaming this out. It seems to me, correct me if I'm wrong, when oil does catch a bid, I mean, that's going to be a violent move upwards. Correct me if I'm wrong.
Yeah, well, and that is exactly what we are betting on at this point. I think people who are saying, okay, once we get the inventories drained, we're only going to see a $5 or $10 pop in oil. No, you're going to see a $20, $30, $40 pop in oil, because you are now at that marginal barrel. And guess what? Why would OPEC come in and just add supply? They talk about spare capacity as if OPEC owes something to the world, and they're going to keep adding supply to bring the price of oil down. They have no reason to do that. They literally control the market at that point. And are they going to let it overheat and get to $140, $180 a barrel? Likely not. However, they could be behind the eight ball, because they were behind the eight ball when they added too many barrels in 2022, going into September, October, November. They added too many barrels. So yeah, they have good data, but there's always a lag in the market, and you could see a big spike, especially if come later this year, shale production starts to really disappoint, and that decline curve hammers away at the U.S. producers. You could see a very, very tight market. But really, has OPEC panicked? Yeah, they're concerned. Yes, they were expecting much higher prices, and they don't have it. At the same time, it's good that they've come to the realization that undersupply means nothing right now. What means something is that actual marginal barrel. And to get to that marginal barrel, you have to drain inventories. And that's where we are. They say, okay, if we can drain inventories in 6 months using a 1 million barrel per day undersupply, why don't we undersupply the sucker by 3 million barrels per day? Because the market doesn't care anyway until you get to that zero excess barrel. And the sooner we get there, the sooner they're in control. And that's effectively where we're headed. And this is such an interesting topic to me. I'm not sure what your thoughts are on this, because there's a common theme that the Biden administration pulled a fast one over the Saudis, and the Russians poked Saudi in the back. But really, I think it's the Saudi Arabians in control, because they realize if they just let this thing simmer away, they not only have control over the market, there is no excess inventory in US or anywhere else, and the US has killed their own shale producer, so their own domestic supply, who are not going to listen to the Biden administration anymore and jack up rigs. So you play this out over a few months, and all of a sudden, the guy who's looking like he's on the ground taking a beating is actually the one with a gun in his hand and going to shoot all these guys who don't have any weapons.
Yeah, right.
So,
That's a very fair analogy. I would agree with you. I think panic is the wrong word. I think the right word is OPEC's concerned and Saudi's concerned, obviously. But let's and again, what do I know? But let's get to draining supply sooner than later is what they're thinking.
Mhm.
And it's one of those things, and I don't want to see it's the fat pitch down the middle, but it's almost that, right? Because you and I are looking at all this supply and demand data and inventory data, and oil should be much higher. And it's
Mhm.
almost like there's a paper market and a physical market are completely different. And at some time they have to meet. And
Mhm.
so it's one of those things that I'm just telling that to myself, as well as encouraging any other investors that I talk to or work with. Just hang in there, just hang in there. But yeah, I guess I just don't see this why this should be going lower or at the price that it is. But you know, um, talk a little bit about oil shale. That's interesting to me because the decline rate, correct me if I'm wrong, at the shale companies is about 50% annually. If I'm on a, and then also you're having a bunch of fires up in Canada in the eastern part, and that's shutting down a lot of production. So we might not even need. That's another issue, if you would, that we have on the production side. What do you know about that? And comment a little bit about that.
Yeah, for sure. So just to go back to your earlier point for a sec, I think the hang in there has unfortunately, we've lost a lot of investors because they've gotten frustrated, they've gotten impatient, which is totally fine. Everybody has a opportunity cost to what they do. This trade has certainly gone from some people thought we could get in, myself included, possibly we could get in. There's going to be this huge ramp, and then you sell and you move on. And I think it's becoming a more of a cyclical, long duration
Yeah.
sort of trade, and um, investors who are not ready to participate in that sort of trade, may have exited or maybe looking to exit because it's going to be that way. But as you mentioned, the two factors have to meet. Unless there's a huge source of supply that comes online from somewhere, there is no other substitution. So definitely, the thesis that I have is more and more tailored now towards a long duration sort of investment. So talking about shale. Shale is one of the big reasons we are where we are. So
Right.
shale grew 1,000,000 barrels per year. Not only did shale oil grow 1,000,000 barrels per year, but the shale NGLs, natural gas liquids, grew 500,000 barrels per year, all the way from 2015 to about 2020. So talk about 1.5 million barrels of supply every single year. And now we have a inflection. Not only do we have an inflection because of capital discipline within the shale producers, the fact that they don't want to increase production anymore, the fact that a lot of private equity, large growth companies have gone bankrupt, but also because of well productivity. So
Sure.
2022 was the first year that well productivity degraded. And why is this important? Because when you look at historically, 2017, 2018 wells were better, 10%, 2019, 2020, 2021, 10%, 10%, 10%. 2022, it's not like well productivity just stayed flat. And so we lost that 10% of increase. We actually degraded 10%. So there's a 20% change in the per well productivity that we had. And this all plays out over time. It doesn't
Right.
just happen all of a sudden, there's this massive decline and shale falls off a cliff. It's all a month by month by month process. So, and then you add in the fact that these wells decline at 60, 70, 80% a year, which means your corporate decline is 40 to 50% per year. And we can see where the problem is at a time when productivity may continue to degrade in 2023. Nobody said that it's going to stay at the 2022 level by any means. So as we see that play out, as we see more and more rigs in the hands of the public producers, the independents, as opposed to the private firms, as we see more and more capital discipline, as we see more rigs being dropped, and the longer oil price stays below $80, $85 a barrel, you're going to see rigs continue to drop.
Right.
Like all you got to do is look at the Enverus rig count or the Baker Hughes rig count. It is a large a slope down. So I think this is one of the things that the market's really missing is, okay, the Russian barrel stayed on the market. Okay, the worldwide demand is this. Okay, OPEC's cutting barrels. But what if shale by December, instead of growing 500,000, as many predict, actually falls 500,000.
Right.
There's a million barrel per day gap in the market right there.
Right.
And that gap cannot be just
turned on or off. Yeah.
in a second. That is a gap that's going to stay there as long as oil stays below $90, $95, $100 a barrel. These, like, the rigs might get added at 80, 85, but the rigs you need are not going to get added until 100 plus or 95 plus.
Right.
So that's really where we need time. Time is on our side. As long as we're in investments that are not going to go bankrupt, as long as we're in investments that we're buying them at 2, 3, 4 times cash flow, I feel very comfortable in that. As far as the Canadian wildfires, there is an impact. We're seeing the inventories in Edmonton and Hardisty come down. That being said, it's not as big of an impact just because it's very a short time frame and the volumes are not big enough. One thing I would keep an eye on is the Gulf of Mexico. We had no major hurricanes last year at all, and this year the weather pattern is again changing into possibly this El Nino pattern, causing more hurricanes. I don't like to predict weather, but let's just be honest. There's always 1 or 2 or 3 events where we lose 1 million barrels per day for a week or 2 or 3. Yeah. And last year we had none. So right. Reversion to the mean is in order.
Yeah.
Sure.
No, that's a great point. No, that really is a great point. And I'm going to Florida here in the next few weeks. So hopefully I have good weather. So as an investor, I mean, there's some great bargains out there, I might say, but what would you recommend, and be just very 30,000 foot view, if you're looking to build a portfolio? And I would highly recommend, I will recommend that at these levels. What are you looking for in companies? Obviously, I would say just they have a lot of cash that they can weather the storm, but what else are you looking for?
Yeah, for sure. So my view is maybe a little bit different than a lot of investors' view, in that when I invested in companies in 2013 and 14, I saw real leverage. And when I say leverage, I say companies with a $500 million market cap with $1.5 billion of debt on it. That is not the company you want to be investing in. Mm-hmm. But we've got companies today that are supposedly huge leverage on it, and they're $1 billion market cap with 200 million of debt on it, is now this highly leveraged company. So I see those companies as relatively safe, especially if they have term debt. So I would stay away from companies with a reserve-based lending facility or some sort of a revolving line of credit facility. I would go with companies with a term debt. So term debt till 2025, 26, 27. That little bit of debt, whatever it is, provides me huge financial leverage on what I'm trying to do. So the companies that I target are the small to mid caps that have a little bit of financial leverage. They have sufficient tax pools to get them through 2, 3, 4 years without paying cash taxes. Ones with exploration and growth opportunities. So we don't want them targeting those opportunities, but if they have undeveloped land, they have proved undeveloped resource, they have 2P probable resource. I like companies with huge resource in the ground, such that when the cycle is in our favor and oil prices are much higher, now we can grow production without having to acquire or run low probability exploration schemes, things like that. So those are the companies that I would target. I would look for good management teams. However, I don't think I would overpay for a good management team. So there are companies that, because they have a quote unquote top decile management, you're paying 50 to 80% more on any multiple. That to me is not reasonable to be paying, because you add a lot of downside risk on that, kind of if oil prices do stay here or don't rise as much as we're looking for. So that's maybe the 30,000 foot view. If you're looking for how I'm doing things, I've gone even lower. So I've gone into the small cap junior growth companies, not aggressive growth, but enough growth such that they can really build a business case out of this. And for the people that follow me, I've gone into some companies through private placements where we end up getting a long duration optionality on the company, whether that is through a 2 or 3 or 5 year warrant. So the opportunities are out there. I don't think everybody should be going completely down the risk curve and going all the way down to the lowest companies, but you don't need to, because companies that are small to mid caps are trading at 2 times cash flow, 2.5 times cash flow, and you get the fact that they're not going bankrupt. You don't have to worry about these risks when the company has a term debt till 2027 and no other debt. And in fact, you can buy debt-free companies if you would like in the small to mid-cap space. So there really is a broad spectrum for everybody, and it just depends how much quote unquote risk you're comfortable with, for that means. So yeah, that's the way I look at this cycle. I see the risk as much lower than what other people are seeing it, because I was in the 2013-14 cycle when I saw companies that were completely over levered. It was not even funny. Like looking back, how did companies like this exist, and how did company like why were investors feeling comfortable investing in these companies? You got to question that. Obviously, hindsight is 2020.
Yeah, I was the same way, so I do get it. So you mentioned management, and I'm really interested in that. How does a person that wants exposure to this and they're looking at a junior company, if you would, how do they analyze the management? How would you go about doing that? And yeah, how can you coach people up on that?
Oh, so this is a very subjective way of doing things.
Sure.
There's not really much I can really like provide. I would say you should look at management successes, not just in a bull cycle, but also what did they do from 2015 to 2020? Were they part of 3 bankruptcies, or were they a management team that were able to sustain their cash flow? They didn't grow too crazily. They still understood what was happening and were able to weather the cycle. I would look at their experience. I am very fond of management teams with engineering and geology backgrounds.
Mm-hmm.
You can say that these people are not the right capital allocators, or they don't have the right pizzazz to go out there. But you know what? You don't need pizzazz these days. When you're running a debt-free company that has the internal cash flow to sustain your growth, you don't need to be the guy out there in boardrooms smoozing with the bankers and the finance people. You can just focus on your geology, focus on your operations, and just execute. So that's a personal bias I have towards
That's a great point. That's a great point.
Yeah, with that sort of background. And then other than that, I would just say talk to them. A lot of these small cap or even mid cap management teams are quite accessible. Say, hey, I want to talk to the CEO. I want to talk to the VP operations. Set up a little small short phone call, research about the company, and ask them pointed questions that are not the main questions, not hey, what is your production, or what is your cash flow? Like, ask them some questions off the cuff. And it's obviously easier to do if you have a background in the industry, but ask them something that's a bit out of the norm, and see if they are able to provide an answer for you. And that's how I think I've decided to get into some of these junior companies. And then there's other companies where the response is just this look of we actually don't know what the answer is at all. We're just trying to sell you on the main pitch. Well, now you got some questions to ask about that as well. So obviously easier said than done for the average retail investor who hasn't been in oil. That's not something you can really do. So I think maybe just looking at them on other interviews or on podcasts, see how they respond, does give you some idea. We're all human at the end of the day. We're not robots. So you can pick up some things, but again, very subjective, right? There's great management teams that have managed to go out and do very poor decisions here over the last couple of years. There's very poor management teams that have really excelled and may excel in a bull cycle that's upcoming here from a structural standpoint, because they've gone and levered up the company, or they've gone and made acquisitions. Those can play in their favor depending on the price environment.
Yeah, got it. One of the things I thought was helpful for me is even going on LinkedIn and just finding the CEO and just looking at his background, just where he's been and how long he's stayed at a certain company, and then just looking at the performance of the company relative to when he was there. And you can find a lot of that information on LinkedIn, or then just a quick Google search. So that's something I do. Wrapping up here, is there any other nuggets that you'd want to share as far as just advice to people that want to get in, have exposure to the oil and energy markets?
So the biggest advice I can give anybody looking to get into oil is understand what you're investing in. This is not your typical investment where you just buy it, and you run the momentum cycle, or you go and, XYZ person is saying this, you really got to understand what you're investing in, supply, demand, inventories. It is work that needs to be put in. There's resources out there that can help you. There's Twitter accounts, there's YouTube podcasts, etc. that's out there. But I think from my experience anyway, I can only share what I think is that people who have gotten into the trade following somebody, or just because they felt it was good, have gotten shaken out because of the volatility. This is a very volatile trade.
Yeah.
The supply demand oftentimes doesn't match up with the short-term trading mechanisms. There's a lot of narratives out there that are completely incorrect, being put out by very, very popular and high follower count accounts. So you just got to be careful with what information you are taking in, and trying to understand what that information means. And once again, this is a task that is not easy, but this is why the oil industry has been shown to absolutely clobber people, but also it's an industry where people have made multi-generational gains in a very, very short period of time, if you can identify those opportunities and have the conviction, if you're correct, to then go and make those sorts of returns. We're not in this industry to make 5% a year or 7% a year. At least I'm not. I'm here to hit grand slams, and that's kind of the way I approach it. That's not the way everybody should approach it. But if you're in this industry simply to save your money and downside protect, this may not be the industry that you're looking for either.
Yeah, no, that's great advice. So if anybody wants to get in touch with you, how can they reach you? An email, or a website, or a Twitter account, or how can they find you?
Yeah, you bet. So I'm most active on Twitter at White Tundra SG. I like to post, here and there about supply, demand, inventories, about the engineering background, about companies. We also host some CEOs on Twitter, so you can come up and ask them questions while we have those sessions live. And then my website is whitetundra.ca. As part of some of the initiatives I host Sunday sessions, so 2 to 3 times a month. Sunday starting at 12 o'clock Mountain Time, I'll go out there. We'll talk about company valuations. We'll talk about acreage. We'll talk about engineering topics. We'll talk about oil and gas macro, and it's all free. And then they're hosted on YouTube as well after that. So I don't know what my YouTube username is, but if you just search up White Tundra Investments, you can find the archives on there as well. So just for an example, this weekend, actually, it's going to be a Saturday session instead of Sunday, just based on kind of my schedule. But we're going to talk about 4 junior companies. So we're going to look at where they are, their management teams, their acreage, their free cash flow profiles, their productivities, some of the unique characteristics about them, and you can learn a little bit on there. So
what time is that on Saturday?
So that right now is scheduled at 12 p.m. Mountain Time. I may move that just because of my schedule this weekend is a little bit sporadic, but usually it's Sunday 12 p.m. Mountain Time, and the schedule is on my website as well. If you scroll to the bottom under events, you can see the schedule. I've got some interesting sessions. At least I feel they're quite interesting coming up over the next couple months here. As well. So yeah, those are the best ways to contact me. And then my website obviously has a contact page where you can email me directly, and I try to respond to everything within a reasonable time frame. Yeah. So
excellent. Well, I just want to thank you so much for your time. It's very informative, and I'd love to have you on again.
Yeah, thanks, Andy. Yeah, good to be here.